Well, good afternoon, everyone. I can't believe it. It is December 15th, only 10 days before Christmas. This is our last podcast for this year. Really, the year has flown by, and wow, what a year. We will do next podcast, we'll do a kind of a year review. And of course, we do a year in review when we have our luncheon, which I want you to go ahead and pencil in from now. It is April 27th next year. It's going to be at the Long Beach Marriott. So mark it from now. But for today, we have a lot to cover. We're going to talk about the historic recent Fed decision that happened on Wednesday, and what does that do with regards to interest rates, because it is all about interest rates. And then we're going to cover some of the clients year-end to-dos that you might want to consider if you have not done so. And then we're going to talk about how Santa Claus is here. He came early. And then Dryden will talk about market outlook for 2024. And then what are the changes, some of the actions that PWM has taken in the portfolios to account for some of the changes that the decision the Fed basically talked to us about on Wednesday, which drove the market up over 500 points that day. So with that background, the most important thing, and what I'm sure all of you want to hear about, is what did the Fed really say? What happened on Wednesday? Why? I mean, on the December 1st, he was very dovish. He was, and then here he is, 13 days later, kind of changed his tune a bit of what is going to happen to interest rates. And so, Dryden.
Christmas came on December 13th.
And
the thing is it was one of those deals that it was a Fed decision day, and the Fed did nothing, yet they did everything. And we've been articulating for a very long period of time that there was a big difference between pause and pivot on interest rates. And we've been in pause mode since July. And this elongated pause, the Fed stopped, they raised rates, they stopped at the 550 level, and kind of strung along what was going to happen. And so they paused. And this comment that Chair Powell made gave clear indication to the markets that the next move would be down, and that while the markets are saying, hey, we may have 5 or 6 cuts next year, the Fed is saying, yeah, maybe 3. But the important thing is you pretty well have taken off a further rate hike off the table. You've given everyone the understanding that the next move probably is down, and that those moves would come in 2024. So we've been saying a long time that we thought moves would come in 2024. The pause would be there. It probably, you're going to have to get confirmation on things. We're probably looking at May, June for the first move, and it's maybe 1 or 2. But I think that's the significant change. They didn't do anything, but they said a lot. And a lot was they put the pivot on the table.
That's it. Pivot.
And I think that's a very key moment. And the question is, and for those, by the way, folks, for those of you watching on Zoom, I put up a slide for you to look at. But if you haven't, I'll just describe to you. The key thing here is that we've continued to get favorable response to inflation. So inflation continues to be directionally correct. It's coming down. Everything that the Fed has done is beginning to work out. We've had this elongated period of time. So in the end, it looks like the Fed sticks the landing. And that's important. We're going to have a soft landing. And, there's going to still people talk about recessions and this and that. Yeah, and I've said this before. I've used this illustration before, but I want to pay close attention to it. When you're driving a car at 90 miles an hour and you slow down to 50 miles an hour, you feel like you're going really slow, standing still, but you're still moving 10 times faster than you can walk. And the point is we're seeing this slowdown in the economy, but it's coming off of a very torrid pace. And so we're actually getting back into a more normal set of circumstances that will be good. So inflation's directionally correct. we don't, while some people are going to say, oh my gosh, it's coming, we're going to have a recession. I don't see it. I mean, GDP growth is still positive. They were predicting about a 1.4. It looks like about a 2.6 now. You're beginning to see, while the JOLTS numbers are coming down, the point is we still have, plenty of jobs for anybody that wants one. So if you think about the components of inflation, or if you think about the components of inflation, you really are recognizing that. I'm going to move this. We're trying to do slides now, but
well, if you look at the slide, you can see that inflation last June was at 9.1%.
Yeah.
Today, 3.1. CPI is 3.1.
And so here's my point. Directionally we're right. We had a little. You got to watch oil prices, because we had a little blurb with that. But bottom line, we're into a targeted area that we've all talked about, this Fed moving from target to tolerance, that this 3 numbers, awfully good. And the other thing that's really important is CFOs and companies are now able to have some predictability. If you take a look at the inflation data that's out there, services is still is sticky, but oil prices coming down is very, very significant. So if you think about what's gonna mess up the game next year, it could possibly be oil prices. But here's the thing that people don't realize: we're producing more oil than we ever have. We're at 13.7 million barrels a day. And in that instance, we're not as dependent on the Middle East as we used to be. We don't have as much geopolitical risk as we used to be. Our oil prices, our gasoline prices seem to have ameliorated a bit. So I think that we're in a situation where we watched for that, but I think we're pretty good going forward. The other thing that this is the thing that I want to point out to everybody. We now have more people working. We have 157.1 million people with jobs in the United States. Now, we were at 152.4 at the peak before the pandemic. So since the pandemic, right, since that peak, we've roared back. We now have 4.5 million more people working, generating $2.5 trillion in income. Ladies and gentlemen, that's the equivalent of the entire economy of Italy, the 8th largest economy in the world. We've taken, as we've recovered from the pandemic, we've grown the 8th largest economy in the world and added on top of the largest economy in the world. When you take that many people and have them make that much money and put that into the economy, the American consumer has a lot of money. And what do they do when they have money? They spend it. They spend it. And so we think that we're going to see a pretty good Christmas coming out of this. Real wages and salaries are at the highest level they've ever been. So none of these things portend an ugly recession. Not at all. I think the Fed sticks to landing. And the point of the matter is we've got inflation going the right direction. We now have interest rates going in the right direction. Okay. Yay. We have GDP headed in the right direction. But I also want to point out that then earnings are headed in the right direction. The driver of performance of the stock market is earnings, and companies are making money. And they're going to continue to make money. And I think that we're going to see this broadening out across the S&P 500. This whole year, the first part of it was the Magnificent Seven. Now we're going to 493. The rest of the companies are beginning to get some respect. They're continuing to beat on earnings. And this is one reason why I brought this up before. CFOs last year and early in the year had no way of knowing what their cost of capital was. So everybody, put their expectations low because they couldn't predict their profit margins. Now they know what their cost of capital is. Now they know their cost of capital is probably directionally going down. So you're going to see, again, you're going to see probably fourth quarter, most of the companies are going to beat. First quarter, most of the companies are going to beat. And then, because you have this normally like 60% of the companies beat. Now we got 80% of the companies beating on earnings expectations. So I really think we continue to see earnings be pretty good. If you estimated earnings growth for the S&P 500 next year is about 11%. the multiple stays the same, right? If you hold that constant, that means you'd see the market probably go up, 7, 9, 11%. So we're actually constructive around that. The other thing that you have to think about too is we have election years, right? So historically in an election year, when you have a president running for re-election, the market's typically up about 13%. So again, we're constructive next year. I gave the shout out on gasoline prices. We have to pay attention to those. Labor force participation rates. This is the thing, at the height of before the pandemic, 63.4% labor force participation. Now we're still below that. We're at 62.8. So we've got room of people to move back into the labor force, and they to solve some of this dislocation that we have. So in general, we're pretty positive all the way around. We've gone from pause to pivot. We've gone from all the statistics are moving in the right direction, so that we have a pretty good outlook on the year. We think the market, between now and the end of the year, it may be a little ahead. We may be a little ahead of ourselves right now, the Santa Claus rally, so we could have some little volatility between now and the end of the year. We think we're in strong because there's an absence of sellers. No one's going to want to sell and incur the capital gains right here when they can just wait another 15 days. So what does this mean? We're going to roll through the next part of the year pretty good. In the first quarter, there's going to probably be some volatility. There almost always is, which is a great time to be prepared to put cash that's on the sidelines to work, because the fundamentals we think look pretty good. And the Fed's looking at this, going to be lowering interest rates. So I think we're in a pretty good position. So if we got excess cash sitting around, you need to be ready, right? So when we get this little volatility at the first part of the year, to take advantage of it. But you can pretty much read this like a map as to what's going on. And we're pretty excited about it. We think it's going to be a pretty good situation going forward. So I hope I've answered all the questions all at once. Everyone should really probably have a delightful Christmas going through. Now, the outlook for 2024 is, again, not hikes, maybe 2, maybe 3 cuts, but latter part of the year, I think. So, I just talked about the economy for the end of the year, Layla. Why don't you talk about
before
action items?
Before we do that, I just want to mention that at the end of October, the 10-year rate was almost at 5%. The 10-year Treasury rate right now is under 4. It's at 3.9. The 10-year rate is what mortgage rates are based on. So you're going to see a good mortgage rate drop by almost 1 percentage point here coming up. I've already seen some of them go down from 7.5 to 6.5. And that should help also the real estate market. It should also help the bond market. I think what Jordan's going to talk about here a little bit later. So there's a lot of good news. It's why the market is having this Santa Claus rally and why we're so positive, because interest rates affect a lot of different asset classes. So Santa Claus is here, and he's here to stay for a while. But there is definitely some things that if you have not done so by year end, we only have 15 more days to, 15 more days to get this done. If you have not done your required minimum distributions, please contact us. There's still several people that we are trying to contact here to make sure we get all those done. Also, if you wanted to do any qualified charitable distributions from your IRA, this is the time to get it done. Also, if you wanted to donate any money, we have a lot of capital gains in your stocks right now. And if you wanted to reduce your taxes and you have a donor advised fund all set up, you could transfer or give some of your appreciated assets into a donor advised fund and get the tax deduction from it. We always feel that it's better to give stocks to charity than to give cash, because then you avoid paying the capital gains on that stock and you get a tax deduction based on the market value of the stock that you gift. And since, we've had certainly a good year, it's always good to give back and to give to your favorite charities. And if you have any intentions or if you'd like to do that, there's very little time to do it, but certainly contact us and see if we can help. Also, if you have any, if your income is lower this year for some reason because of work or so, and you've been thinking about doing Roth conversions, then again, you only have a few days to do so, but we can still do it if you are in a low tax bracket this year. Also, make sure you've maxed out your 401k contributions. It is for people under age 50, it is $22,500. For people over age 50, it is $30,000. Make sure and look at your paycheck stubs and make sure you're maximizing your 401k contributions before you end. What's really nice is next year, I talked about that last time, the amount that you can contribute into an IRA is up to $7,000 for under 50, $8,000 for over 50. 401k contributions are going up, gifting is going up. The fact that we have inflation, we should have some pretty good numbers next year. Next year is probably the last year we're going to have some generous limits go up because, as Dryden just talked about, inflation is coming down. So 2025, the numbers are not going to be as good as they are in 2024. And make sure and attend our luncheon because we'll be talking quite a bit about some of the unusual planning that will be available for 2024 that we may not have in 2025. Because, as you know, one of the things that we really pride ourselves with is not only do we manage your assets, but we really do all your planning, and it's the wealth management and the financial planning and the estate planning and the insurance and long-term care. So all the things that we do that get you to your destination, and that's what Penn's Wealth Management is all about. Little advertising here. Okay. Now, with that, I want to go back and have you, Dryden, talk a bit more. What are the changes? The fact that we know rates are going to come down next year. We're much more positive about that. You know, whether they'll go down 3 times or 4 times or 5 times. You know, if you've wanted to lock up some interest rates, there is now ways. You know, we don't think we're going to see the high rates that we have now anytime in our lifetime in the future, because I don't think inflation is going to go up as much, because I don't think we're going to have another COVID. But that's just, you know, at least in the next 5 or 10 years. So if you wanted to have the money locked up in the higher interest rates, you know, this is the time to contact us and see what options are available to do so.
We've been, you know, throughout most of this, we kept the fixed income positions fairly short, and that ended up being the right thing to do. We're now to that moment, as we know, we're at this pivot point, that probably moving out on the duration curve a little bit, locking things up a little bit. We know that the next moves are down, so that tends to be a favorable thing for the bond market. As you know, when interest rates go up, you know, bond prices go down. When interest rates go down, bond prices go up. So you have some ability to not only get a pretty darn good interest rate in relative terms, but also some possible capital appreciation. So money that is sitting on the sidelines could go into fixed income positions now with a little bit longer duration than we've been using, and grab that coupon for a little bit longer. So there's a change in how we're dealing with that. You'll see some of that in your accounts and some of the things that we do. We're going to kind of stretch out that a little bit, but if you've got money sitting around, there's ways to put that to work now and get attractive interest rates. Now that window is going to be short, right? That window is going to be closing. So you can now and maybe through first quarter, but that's about it. Now that's the first big move. Now the other thing that you see in market cycles like this, you know, Dow's near record, NASDAQ's record, you know, S&P's record, but the Russell is not. And so when you think about the Russell is the very broad-based smaller cap companies. So you're basically have seen a lot of small companies and small cap companies haven't appreciated quite as well, although their economics are still are fundamentally sound and getting more sound, we think. So if that's the case, you're going to see us put a little bit more small mid-cap exposure into the accounts, grab some of this earnings growth. I mean, here's the other thing to think about, focusing on the United States. If you needed to raise your prices, you did. if you didn't need to raise your prices.
You did.
You did. And so companies that pushed through a price increase in their products over the last year now are seeing, the wholesale prices come back down a little bit, interest rates come back down a little bit. All of that turns into margin expansion. And so we think that the small and mid-cap space is going to be attractive going forward. This is still very much a stock picker's market, though. And we want to look for companies, again, big noble themes, identify the choke points, target best of class. But I think we like the equity markets. Clearly, like we say, the 493. You had the 7 big companies, and we think they'll still do very well, really propelled this market this year. And it's the broadening piece of the S&P 500. So we think we're positioned for that now. We think we're well positioned here at the end of the year. So there won't be a ton of changes, but I think that we'll continue to monitor and make some more changes in the portfolios based on this general trend that we see. We'll be trimming some winners, we'll be rebalancing a little bit, but I think we're well positioned for what we see going on over the next 6 to 9 months.
Very, very good. So back to locking it, what's going to happen is that, for those of you who have had CDs or money markets, in the 5% range, that's going to start to come down, okay? The market starts anticipating the Fed reducing interest rates. So for your safe money, if you've had safe money in the bank or somewhere where you really, you enjoyed the 5 or 5.25%, or even on the T-bills, next renewal, you're not going to get that. If you are interested in locking some of those rates higher, I can't tell you how important it is to act now, because that window is closing, and it's closing fast, especially if the Fed turns around and actually accelerates the drop in interest rates. So you need to contact us and talk about options that you may want to consider if you're in that camp where you'd like to keep some of your safe money for some safety and some higher interest rates. The window is closing because of what the Fed did, and truly pivoting like they did on Wednesday.
I think we've pretty well covered just about everything.
Yes.
And in record time, ladies and gentlemen, we're 3:23 as opposed to 3:30. So we just want to take. Go ahead.
One thing is that, as you know, it is our tradition as a firm to do a Toys for Tots gathering of unwrapped gifts. We do have boxes here in our offices. If you would like to participate in that and donate to Toys of Tots, we have 2 boxes here. You're welcome to drop by and donate your unwrapped toys so that we can bring some joy for some of the unfortunate children that don't have the ability to enjoy Christmas as we do, and as we are truly blessed. It's a fabulous charity done by the Marine Corps Reserves, and if you've got a new unwrapped toy, please bring it by the office. Next Wednesday, we'll be turning all those, actually probably next Tuesday, we'll turn all those into the Marine Corps so that you can get them. So like, you've got some stuff you get over the weekend, bring it by on Monday. We'll make sure it gets in the hands of the Marines. They'll make sure it gets in the hands of the children that really, really need it. But with that, we want to take one more thing. One more last thing. Our next podcast, okay, write it down from now. It is going to be back on Thursdays, which is January 25th. Okay, 24. Can't believe it's going to be 24. I have trouble with that year. But it's January 25th, 24 is our next podcast, Mark It From Now. So because there'll be a whole different year, but we'll have a lot to cover and a lot to tell you. And make sure that when you get your podcast, when you confirm, if you have any questions for us, make sure and write them in before that. Now, Dryden. Well, like I said, and then for those of you who get to watch this on Zoom, I've started posting some of my slides. So I know people like those, so we'll try to have that available for you so we can kind of combine those so what videos with doing the podcast. So I'll have 5 or 6 slides on there for those of you looking Zoom, and for those we can get a replay pushed out as well. But having said that, I want to take the opportunity to thank everybody.
it's been one of those crazy years, and it's been a year that's worked out well. There's been some tough moments and a lot of volatility, and people, some uncertainty. I hope, Layla, that we've been able, by doing these podcasts, we've been able to, kind of tamp down some fears and concerns that clients have, give them some assurance that there's a steady hand on the wheel here.
We're here for them.
And we're here for you, and answer some of your questions going forward. And I think that the year's turned out very, very well, and we're constructive around 2024. But I think that, again, feel free to share this podcast with your friends, have them join us. We're here to give out information, make a few suggestions, and serve you as best we can. It is an honor and a privilege to do that, and we appreciate the faith and trust that you have in us. So from our family to yours, from the entire Pence organization to all of you, Merry Christmas and Happy New Year.
Talk to you next year.
Thank you.
Layla Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Dryden Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. The financial professionals affiliated with PWM are registered representatives with and securities and investment advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Pence Wealth Management PWM and LPL Financial are separate entities.